Is your group RRSP not growing as much as you thought it would? I was jamming with one of my clients and I discovered she was about to lose out on over $300,000 in the next 25 years, which works out to be around $13,000 per year. Too much money. And this is a very common mistake I see all the time. If you have a group RRSP that's not doing so well the last 5 years or more, and you're wondering why you're making 2% per year in annualized returns, stick around and I'm going to show you what my client was invested in and what her new portfolio looks like now. Chances are you could be in the same boat as her. My name is Michelle Hung. I'm an author of 2 investing books, The Sassy Investor and Investing for Teens, How to Save, Invest, and Grow Money. I'm a financial educator and fee-only financial planner, helping people build their $1 million investment portfolio in the stock market. In this video, I'm going to walk you through the types of funds that we selected and why, so that if you need to rejig your group RRSP selection because maybe you have chosen something that's in the low to medium risk level, and that's probably why your investments haven't been growing. So you now have an idea of how to change your selection so that you increase the potential returns on your investments, which will help your portfolio grow faster. The primary reason for my clients' lackluster growth, and I see this again happen very often, it's because she chose a balanced fund. In this case, it was comprised of 58% equities and 42% fixed income with a heavy geographic exposure to Canadian stocks. She was basically in a fund that was meant for someone who was nearing retirement. It's a couple of decades ahead of herself. That's okay, we fixed it. So if you chose a balanced fund or an income fund, those will fall into the low to medium risk categories. So what we did was we went through the list of funds that were offered to her. I'm going to show you in this work document how group RSPs are structured generally, how they're broken down, and I'm going to walk you through a brief description of each of those categories. I'm not showing you specific funds, but just showing you the general categories, which will give you an idea on how to select your investments. What was being offered in her group RSP are funds that were broken down into several categories: asset allocation funds, equities, and fixed income. Now, she decided because she was a couple decades away from retirement and she wanted to maximize her returns. She doesn't want to be in fixed income. She wanted 100% equities in her retirement portfolio. So we're not going to be talking about fixed income. So what I'm going to go through are these 2 categories. So first off, asset allocation. Now, under asset allocation are several types of funds, and you're going to see these types of funds with BlackRock and Vanguard, any of those ETF providers or fund providers that provide these basically all-in-one funds that make investing so much easier for people. And what happens is they basically choose the asset allocation for you. That means they're going to be, these are predetermined mixes of bonds, or fixed income and equities. So with an income fund, generally speaking, they're comprised around 20% equities and 80% fixed income. So a lot of interest payments. The point of this is to be replacing your retirement income. So if you're in retirement, or your goal is to make sure your capital is being preserved, capital preservation, or you want minimal fluctuation in your stock portfolio and you're looking for just predictable recurring income, these lean towards the lower risk category. Your portfolio is not going to grow a lot because these are low risk investments, but you will be receiving predictable recurring interest payments from the fixed income, and maybe a little bit, because there are equities in there, from dividends of companies that are relatively very stable and don't grow a lot, but they produce a lot of cash. Next are balanced funds. So it's roughly 50-50 equities and fixed income. So again, this is what my client was in. It wasn't exactly 50-50. It was 58-42. Sometimes it's 60-40. But this is basically just the make of it. It's roughly 50-50, 60-40 with balanced funds. So these are for people that are nearing retirement, that are approaching retirement, and they prefer a lower risk, like a low to medium risk style of investing. They don't want too much fluctuations in their portfolio. They want a little bit of growth, but also making sure they make some income. So that's why it's only half of the portfolio is in equities and the other half in fixed income. So there's going to be a combination of dividends, interest payments from the fixed income and a little bit of growth from equity. So as you can see, compared to like an all equity fund where it's like 100% in equities, think of it as half of the portfolio is being diluted with fixed income. So it will hamper your growth. It's going to slow your growth down. This is where people that are nearing retirement or those that really prefer low to medium risk level of investing. And finally, with all equity funds, it's just, speaks for itself. It's 100% in equities. It's all stocks. You're going to get maximum growth by being in all equity funds. So you're going to get a combination of stock price appreciation. And of course, there's still going to be income that's going to be hitting your account in the form of dividends. So you're going to get dividends and stock price appreciation. What are the pros and cons of these asset allocation funds? Well, they're super simple because you can get away with investing in any one of these depending on the allocation that you want for your portfolio, depending on the risk level, and you'll be good, right? Super simple, kind of like one-stop shop, right? However, these funds are generally higher because usually these funds contain other funds inside these funds, because any given, like one single balance fund can contain, like 12,000 companies. And of course, whomever's managing this balance fund is not going to have 12,000 companies. They're going to put other types of funds, maybe several funds, and each of those funds contain 100 or like several hundred companies. So there's basically funds inside these funds. So that's why the fees are just a little bit higher. And of course, because it's kind of like a one-stop shop, you're not going to have control over your allocations or investments. Then we have equities, and it's broken down into these 5 categories. So first, there are Canadian equities. So just, a Canadian equity fund, they're going to contain like the typical companies that are in Canada. So what do we have in the Canadian economy? We have, 6 big banks, TD, Scotia, RBC. We have 3 massive telecom companies, Bell, TELUS, Rogers. We have our tech darling Shopify. We have 2 airline companies, Air Canada, WestJet, and a whole bunch of resource companies, oil and gas, mining and exploration companies. So this is basically the make of Canada's economy. So when you look at Canadian funds, any Canadian mutual fund, any Canadian ETF, you're going to be seeing the same types of companies over and over again. So when we see that, I always say, well, you might as well choose the fund that has the lowest cost, right? Because the reality is ETFs, mutual funds, they're like a commodity. There's so many choices available. So you might as well pick the lowest cost one. Everyone is more or less invested in the same thing. So why would you pay more? And then with US equities, US stocks, what's in the US? We have the tech giants of the world, Alphabet, Apple, Amazon, okay, big brands like Walt Disney, Starbucks, Walmart, big banks like JP Morgan, Goldman Sachs, Wells Fargo. And I just want to point out that approximately 50% of the world stocks, global stocks, are from the US. So it makes sense that if you have a portfolio and half of it's in US equities, that's okay because, well, 50% of the global stocks come from the US. They have such a massive economy. Then we have everywhere else in the world, global equities. And that's broken down into either being a developed country, okay, so developed countries outside of North America, because we've already covered those. So countries like, Switzerland, Germany, Singapore, Japan, England. And then there are emerging countries under global equity. So countries like China, India, Brazil, okay, so emerging countries generally will exhibit higher growth, higher risk, and thus higher returns. And then we have real estate income trusts, REITs for short. When you see REITs, you're going to see different types of real estate companies, that cover residential real estate, commercial real estate. What these are good for are income and modest price or long-term price appreciation. So if you're looking for a way to get into real estate without directly getting into real estate, investing in REITs is a good way to do that. And then there are dividend funds. Okay, so this is a must-have in your portfolio. I have another video that talks about why dividends are excellent for your portfolio. But for now, I just want to show you that with the dividend funds that were available, there were Canadian dividend paying companies, which comprise of, again, a lot of our big banks, like Scotia, RBC, TD, and we have a lot of utility companies that are just cash cow and they pump out a lot of dividends for their investors. And then as for US dividend paying, US dividend funds, US dividend paying companies are centered around healthcare and banks. And then, of course, there are dividend funds that cover global countries outside of the US and Canada. Ideally, what you want is to just have a little bit of everything from each category. My client's new portfolio in her group RRSPs now look like this. She selected a couple of asset allocation funds that are 100% equities, super simple. She selected a low volatility foreign equity fund, which means these are foreign stocks outside of North America that have companies that are low in volatility, meaning their stock prices are not massively swinging. There are low fluctuations in their stock prices. So these are companies that are relatively more stable. She chose a Far East fund. And then finally, 15% of her allocation is going towards a Canadian dividend equity fund. If you want your portfolio to actually grow, you gotta get out of these balanced and income funds. I always say you're already investing your money and you're not gonna be touching it for a very long time. So you might as well make the most of it and maximize your returns. If you're tired of your portfolio not growing and you want someone to help you build one out so you make the most of your investments and maximize your returns, then apply for a spot in my Wealth in 7 program and we can chat to see if you're a good fit for this program. The link is in the description below.